Hi guys, Ben here and welcome to Motivation to Invest. Howard Marks is one of the greatest investors of all time. As founder of OAKTREE CAPITAL, which manages over $120 billion, he has beat the market multiple times and is a strong advocate of market cycles. He believes everything is governed by cycles, the economy, the stock market, and even life in general. He has predicted many of the previous stock market crashes, and his iconic memos are read by the likes of legendary investors such as Warren Buffett. In a previous interview, he stated, "We cannot predict what will happen tomorrow, but by knowing where we are in the market cycle can help us to predict the probability of future outcomes." His whole investment strategy is being a contrarian investor, which is observing the masses and doing the opposite. So in this video, I'm going to outline Howard Marks' 10 rules for investment success. Let's dive in. Welcome back guys to Motivation to Invest. Before we get started, go ahead, smash that like button for the YouTube algorithm. That allows us to continue creating more great content like this for you guys. In addition, if you would like more investment tips and exclusive stock market picks, which I personally have invested into, then you should definitely subscribe to this channel. Be sure to turn the notification bell on. That way you'll get notified when a great stock is at a great price. So that being said, let's get into the video.
In times of chaos, investors fail to make fine distinctions. So things go down more than they should and less than they should. We have an opportunity, we think, to find the things that have gone down more than they should. It's a better climate for getting bargains today than it was 2 months ago.
And I reached the conclusion that when optimism is excessive, my job is to say that's too good to be true. When pessimism is excessive, it's my job to say that's too bad to be true. And that's how we've made money in the crises. And, when I reached that conclusion in 2008, I ran back to my office, as you know, because you've read my books, and I wrote a memo called The Limits to Negativism. And I said, negativism is excessive, which means that we should move into an aggressive gear, and we did.
In 2006, I wrote a memo with a clever title, Risk. And I tried to put down everything that I could think of about risk that I knew. And so I'm sitting there typing it out, and I wrote that you can't measure risk in advance. You can't quantify risk in advance. And I think that's true. You can't measure risk even after the fact. You buy something for $100. A year later, you sell it for $200. Was it risky? 7 worst words in the world, and I believe they are too much money chasing too few deals. And because when there is too much money chasing too few deals, and the money is in the hands of people who are too eager to put it to work, and who are too driven by fear of missing out, and not afraid enough of losing money, then they bid too aggressively for securities, which takes the form of driving down prospective returns and driving up risk.
Some people want to wait for the bottom. Well, is it better to buy now if you see a bargain than to wait for the bottom?
Well, I could ask you, what is the bottom, Eric? And
I have no idea.
Well, no, it's easy. The bottom is the day before it starts going up. But how do you know?
Right.
That's why I asked. The bottom is only judged in retrospect. So you never know when you're at the bottom. But you might have a feeling that something's cheap. And if it's cheap, you should buy it. If it goes down more, i.e. that wasn't the bottom, if it goes down more, buy some more. And keep your nerve and continue down as long as your assessment is right.
In cycles. In other words, things will go well. They'll reach a point beyond which they can't get better. And by definition, they'll start to get worse. And then things will deteriorate. And then they'll reach a point beyond which they can't get worse, and then they'll get better. That's the belief of someone who follows cycles, and as you know, that's me. I've lived through half a dozen cycles, substantial economic and market cycles in my 51 years in the investment business, and I believe that we always will have cycles. The interesting thing, if you pay attention, is that when things have gone very well for a long time, people start to say, well, maybe we won't have any more cycles. Maybe it's going to go straight up forever. And of course, that is the exact time when the probability of a decline is the greatest. We're seeing that now, unfortunately.
The cycle and where we stand in it. I don't believe in predicting the future. We never know where we're going. We should understand the present. And where we are in the present, where the market is relative to its cycle, tells you something about the odds that govern the future. Doesn't tell you what's going to happen tomorrow, but I believe that we can only understand, since the world is an uncertain place filled with randomness, we can't know what's going to happen in the future. But those of us who see the world more clearly than others can have a superior understanding for the probability distribution that governs the future. What things can happen, which are most likely, which are somewhat likely, which are unlikely. If you have that consistently, you are a superior understander, and you can be a superior investor.
Key to success is to establish a portfolio so that if the market goes up, you will make money, and if the market goes down, you will survive.
Controlling risk is the mark of a professional. Anybody can make money when the market goes up, and most of the time the market goes up. And anybody who takes above average risk can do above average when the market rises. So achieving returns is not a point of distinction in good times. In my opinion, the distinction of a superior investor is achieving returns in good times with the risk under control. Because you never know when the environment is going to shift from favorable to unfavorable, and the question is, are you prepared? You know, somebody who, if the market's up 10 and you're up 12 and the market's down 10 and you're down 12, you didn't accomplish anything. The question is, can you make more in the good times than you give back in the bad times?
In Japanese philosophy, there's a concept called mujo, which basically talks about the impermanence of things, the changing nature of things, the difficulty of controlling things. You can't bend the river. It taught me that there are things beyond my control and beyond my knowledge, and that the key is to deal with them effectively. I consider that one of the most positive influences that I was fortunate to enjoy.
And if you enjoyed this video, go ahead, smash that like button, and definitely subscribe. See you next time.